Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me is Eric Clapsaddle, our Senior Fixed Income Portfolio Manager. As you know, Eric, I just returned from a trip to Colorado, and on our flight out to Denver, we basically ended up circling the city briefly or being put in a holding pattern. And that got me thinking, we seem to be in a holding pattern in a lot of different parts of the market today, especially after the Federal Reserve's most recent action. So, Eric, can you talk a little bit about interest rates and the Federal Reserve and what you're seeing there?
Yeah, absolutely, and you're spot on, Paul. Based on information, data that we're seeing from the Federal Reserve and the markets, we believe that we've seen peak interest rates. The graph on the screen shows the Fed's infamous dot plot, and that the Fed is telling us that they will probably not raise rates again this year, but they're also telling us that they won't be lowering them this year. The markets don't generally agree with that. Most market participants now are expecting the Federal Reserve to cut their target rate by 0.75 to 1% through year end.
So we know, Eric, that what the Federal Reserve does doesn't automatically apply directly to the bond market. It has its own mind sometimes. So what are we seeing with interest rates in the bond market?
Sure. As you know, the Federal Reserve raised rates again on May 3rd, bringing their target rate to 5 to 5.25%. Despite that, interest rates have remained mostly stable so far since the beginning of the second quarter. You can see in the chart of the 2-year Treasury note that what we are experiencing is a lot of daily volatility in yields, but where we are today and at the start of the quarter has changed little. A lot of that has to do with slightly lower than expected inflation to meeting expectations, and also the labor market starting to show some cracks. Initial jobless claims on May 6th, the week ending May 6th, actually came in at their highest level since October of 2021, and job openings declined to their lowest level since April of 2021. With that said, though, both labor and inflation have a distance to go before the Fed is happy with where they're at.
Very good, interesting observations on the fixed income markets. So obviously we know rates have kind of gone nowhere for the last 6-7 weeks. What can you share with us on the equity markets?
Sure. So equity markets, they're slightly positive so far this quarter, certainly within the S&P 500. But when you start stripping out some of the mega cap large tech names like Google, Microsoft, Apple, you start to see a market that's barely positive, possibly even some parts negative. There's two things at play here. One being we've seen good corporate earnings and revenue so far this quarter, but on the flip side, we've seen a lot of loud negative news surrounding regional banks. And you've seen the SVB, First Republic, Signature Bank all fail, causing some stresses in different parts of the market. That is why we believe, we always preach that a diversified portfolio is really the way to reduce short-term volatility, but maximize long-term growth.
Eric, you mentioned earlier about the slow decline in inflation and the softening labor markets. What other things are we seeing in the economy today?
Sure. So starting to think about the consumer, which is the most important part of the U.S. economy, they've been resilient, but most definitely starting to feel squeezed. As you can see in the chart, credit card debt has continued to rise to historical levels, while the U.S. savings rate has fallen back to levels we haven't seen since 2009. Individuals are using growth in wages, reduced savings, increased credit card debt to really keep consumption and retail sales at a nice growing pace. On top of that, the Institute for Supply Management, they're releasing data that can go either way as far as the overall economy, but has pointed to the manufacturing sector in a contraction territory over the past 6 months. But the service sector, which is the largest part of the U.S. economy, has continued to grow, though at a much slower pace.
Well, Eric, as always, really appreciate your commentary on the markets, particularly on interest rates. As we're shooting this video, we are also waiting for the debt ceiling limit issue to be resolved, and that's another reason we're kind of in a holding pattern until that gets resolved. Either way, as we look to the investment horizon, First Source is always looking for opportunities to improve our clients' portfolio and to help you achieve security, build wealth, and realize your dreams. As always, thank you for the opportunity to serve you and your family.